Hello dear students, in this video we are going to cover time value of money, one of the most important topic of agriculture, finance and insurance. Myself Professor Vaishali Bharat Ghola. See, time value of money. Investment in agriculture is of two types. Okay, first type of investment is operating investment, or it is also known as working investment on the working inputs. Okay, and means investment on working inputs or operating example are the purchase of seed, fertilizer, pesticides, insecticides, okay, feed are the example of investment on operating or working inputs. And second type of investment in agriculture is investment on capital assets, means purchase of land, machinery, livestock. Okay, analysis of investment is different for the for these categories, that is investment on operating or working inputs and investment on capital assets, due to the difference in the timing of expenses and their associated returns. Okay, in case of operating investment, expenses and returns fall within a production cycle or a that specific year only. Okay, time element is not brought into consideration in analyzing the profitability of operating inputs, because in this case both expenses and returns are assumed to fall in same production cycle. But in case of investment on capital assets, or we can say the investment in agriculture project, are made in different time periods and the returns are also spread over the time. In order to assess the return from investment in case of capital assets, uh, we have to consider the time value of money, or we have to give the weightage for the different length of time in respect of cost and return. Here we need to recognize, or we need to study the concept of time value of money. Under time value of money, there are two important concepts, compounding and discounting. What is meant by compounding? Compounding is a future value of present sum. Future value of present sum is, we call it as a compounding. A rupee today is worth more than a rupee in the future. This is primarily due to its opportunity cost. Here opportunity cost is nothing but the interest. Okay. Interest will be added to the principal over the time and hence its value increases. Future value of present sum is an important concept in financial analysis and this is called as compounding. Okay. In compounding process, the interest is added to the principal at the end of each time period, which in turn earn the interest. Okay, the future value of present investment is calculated with the help of this formula. Future value is equal to present value 1 plus interest raised to t. Okay, this is the formula for finding the future value of present sum. If we want to find out the investment, okay, if we want to find out the future value, if we invested 10,000 invested in the saving account with the compound interest rate of 10% per year after 4 years, that we can find out with the help of this formula. Future value of 10,000 if we invested that amount for the 4 year with the compound interest rate of 10%, that we can find out with the help of this formula. Future value is equal to present value 1 plus I raised to t. Okay, then annuity. Annuity is a stream of payments or receipt over the time, or in other words we can say the fixed payment or receipt each year for a specified number of year is called as an annuity. Suppose rupees 10,000, sorry, suppose rupees 1,000 is deposited at the end of each year in saving account at the rate of 10% interest. What will be the future value of this investment at the end of 4 years? Okay, this is the example of annuity. Okay, we can see with the help of this example. Listen carefully. Suppose rupees 1,000 is deposited at the end of each year in saving account at the rate of 10% interest. What is the future value of this investment at the end of 4 years? Okay. First year we invested 1000 rupees. Okay. That's why we will get the interest for 3 years. 1001 plus 0.1 raised to 3. At the end of first year, the value of this 1000 will be 1331. Similarly, in second year, also we invested rupees 1000, but that investment is for only 2 years. That's why here we write down the 2. 1001 plus 0.1 raised to 2, that will be the 1210. Third year again we invested 1000 rupees, 1001 plus 0.1 raised to 1, because this amount is deposited for the 1 year, because this are we are doing continuously till the 4th year. That's why here we have I have written 1100. 4th year 1000 again, 1001 plus 0.1 raised to 0, that is 1000. Then addition of each year value will get the future value of this investment at the end of 4 years. That will be the 4641 rupees. This we can calculate with the help of this formula also. Future value is equal to present value, that is 1000, 1 plus 0.1 raised to 4 minus 1 divided by I. That will give the same value, that is 4641. This is the concept of compounding. Okay, what is meant by compounding? Compounding is nothing but the future value of present sum. In next slide, we are going to see the discounting. This is the opposite of compounding. Okay, discounting is a present value of future sum. Present value of future sum is known as, it is called as discounting. Okay, the present value is worked out through the discounting process, in which future sum is discounted back to the present time to find out its current or present value. That we call it as a discounting. Okay, and formula for finding the present value of future sum is present value is equal to future value divided by 1 plus I raised to n. For example, if we want rupees 5000 in future, okay, after 3 years, if we want 5000 in future after 3 years with a 10% interest rate, what will be the present value? For that purpose, we are using this formula. Present value is equal to future value 1 plus I raised to n. Okay, I want to know the present value if I want rupees 5000 after 3 years. Okay, that we can calculate with the help of this present value of future sum. Okay, now here also annuity concept is we need to study. That is, annuity means what? Annuity is nothing but is a stream of payment or receipt over the time. The present value of annuity is calculated with the help of present value is equal to future value 1 minus 1 plus I raised to minus n divided by I. Okay. An investor may receive constant amount periodically for a certain number of years. The present value of an annuity cannot be found by using the formula given above. This is, we cannot find out the annuity with the help of this formula. Okay, in order to find out the present value of an annuity, we have to find out the present value of amount every year and have to aggregate all the present value to get the total present value of the stream of payments or receipt. We can use this formula for finding the present value of annuity. That is, present value is equal to future value 1 minus 1 plus I raised to minus n divided by I. Okay, this is the annuity in case of present value of annuity. Okay, this is all about time value of money. Thank you.